You have two choices. You can either be upset or in awe of Trump paying so little in tax. But either way, there's something you can learn from Trump's taxes, or lack thereof. There are ways for you to legally pay less in tax. And the majority of people, they're just tipping the government. They're paying way too much in taxes. And if you don't do these three things, the chances are you're going to be one of those paying way too much. So look, there's plenty of controversy, attention, outrage, you name it, about Trump paying so little in taxes. And it feels like a mystery to most, but in reality, there's something you can learn and apply to use the same rules for your advantage. So let me break this down into three simple parts for you. The first is Donald Trump owns businesses and real estate. When it comes to the tax code, the first few hundred pages tell you exactly why you have to pay tax. The next several thousand are how you can navigate that system in a more tax efficient and tax-free manner. And it's really an advantage for business owners or people that are spending a substantial amount of time in real estate. So they both have very specific tax advantages. Let's begin with real estate, for example. If you're ever designated a real estate professional for tax purposes, that doesn't mean you go get any licenses or anything that way. What it really means is you're spending 750 hours of your time, or if you have a significant other, their time managing real estate, buying real estate, dealing with real estate or any type of real property. And when that's that amount of time, you get an unlimited amount of write-off when it comes to all of your real estate. So if we compare that to an active investor or a passive investor, passive has a lot of limitations as to what amount of write-off that you can take, and active even has limitations, because a lot of time what it's going against is passive-based income versus all the income that's out there. So tax losses and deductions, that can become tax-free cash flow through being able to deduct 100% of your rental depreciation and losses against any other type of income. That's what being a real estate professional is. And let me say, what does that even mean? Let me translate that here for a minute. When it comes to real estate, you might have it appreciate or grow in value over time. But there's certain things that have a depreciation schedule because you're not going to keep the same carpet. You might have to repaint the walls. There might be a heating system that goes out over time, right? You have things that are losing value or depreciating, and you get to write that off as losses against any type of income if you're a real estate professional, but you have limitations if you're just a passive investor. Maybe you just hand your money over to someone and they handle it for you, or you're somewhat active but not at 750 hours. It gets you a little bit more advantage. But look, when you're considered a real estate professional, which when you look at Donald's portfolio, he has a lot of real estate, so he has this huge tax advantage. Now, the other thing, when it comes to real estate, is something called cost segregation. Now, don't let the complicated nature of the sound kind of confuse you. Let me be really clear. Cost segregation would say normally it could take up to 39 years to get all your depreciation and losses from real estate. But if you have commercial real estate, which would be more than a fourplex, if it's something you're renting out as a residential piece, or it's actually an office building, that would be commercial-based real estate. Cost segregation is where you bring in an engineer. That engineer says, look, this is only going to last for 3 years, and this is going to last for 7 years, and they separate everything that you have in your real estate, in that commercial property, or segregate it so that you can start to accelerate depreciation for tax write-offs, right? So cost segregation, and we're talking about real estate professional designations. Those are two pieces that Donald Trump is able to use to his advantage to pay so much less in real estate. Now, you can also use a special trust to sell property tax-free. This is called a charitable remainder trust, and it transfers the property, right, where you can put it into a charity. You get a tax deduction for the estimated amount that the charity is going to benefit, but when you sell the property, you pay zero tax upon that sale. So no tax upon the sale, and a tax advantage when you put it into the charitable trust. Look, I'm planting seeds here so you can dive in deeper, and I'll have other videos with my company Wealth Factory if you want to go through some of these more complex topics, or you can go to wealthfactory.com/tax to start taking advantage of some of the things I'm talking about here. But another thing that happens with real estate is there's something called a 1031 exchange. So a charitable trust can allow you to sell it tax-free, but a 1031 exchange can say, hey, you're going to buy a bigger piece of property, like the game Monopoly, right? You go and you buy the first little houses, and you eventually want to turn those into hotels. Well, if you're starting to, buy bigger properties or properties worth more, you can exchange your gains if you sell one property and roll it over into another property. That's a 1031 exchange. exchange, and that can avoid taxation. Plus, if you ever borrow, if you ever get a loan and you want to access equity, which is the difference between your asset and your liability. So let's say you had a $200,000 property, you owe $100,000 on it. You can go get a line of credit for that $100,000 of equity. And if you use that money, there's no tax when it's against a loan. So you've essentially got to the equity of the property without taxation. Or, as I mentioned, you can roll it over to another property, or you could sell it through a charitable trust and pay no tax and actually get a partial tax deduction. And in that trust, you actually can take between 5% and 50% income off the money in the trust because you're the first beneficiary, the charity is the second beneficiary, and you can still invest that money. So for some, you might be going, oh my God, this is over my head. Look, you think that Trump understood all this from day one? I mean, he's just got an amazing team around him. And so let me give you one more thing on this first step before we move into the next step, and that's something called a conservation easement or historical easement. And what this can do is give you massive tax deductions because you give up the rights to develop land, or because you own a building and it's a historical building and you give up the right to ever tear it down and build it in a different way, and you can give up the facade of that building, right, that kind of, and say, I'm never going to change this facade so it remains historical, and you can get major tax deductions. I'm talking about substantial. One story is someone that had a bunch of property in Florida where these digging turtles lived, and they said, look, we don't want to develop this because these are endangered species, and they got a major tax deduction worth more than what they actually paid for the land. Or another guy that owned property in West Texas that had a lot of sand on it, wasn't able to sell it for what he wanted to sell it for based upon what he bought it, but he was able to do a conservation easement saying that it'll never be developed on, but they do an assessment if he would have given that sand up in development for fracking, and it got him a huge tax deduction. So these are, major strategies that are available to anyone that owns property or does real estate or does a certain amount of time in real estate. You don't have to be uber wealthy or uber rich. As a matter of fact, there was a time where I started to do a lot of real estate back early in my career, like in 2001 is when I started, and I bought a lot of property between 2001 and 2007, and I owned anywhere from 20% to 100% of just over 100 doors. And you know what? Because of what I've talked about here, qualifying for all these things was the time I paid the least amount of tax in my entire life. The problem is, I didn't really love the time I had to spend in real estate. I'd rather be putting together these videos and meeting with people to help them have financial breakthroughs and grow their businesses and be more in creating intellectual property than the property of real estate. But look, this is the bottom line, is you can pay so much less in tax, and with the new Trump tax plan, there's even more advantageous nature to real estate. So that's one. Let's go to the second piece here. Why is it that Donald Trump pays so little in tax, or says he pays no tax at all? And when I interview Robert Kiyosaki, he says he pays no tax at all. Well, the second thing is, it's money well spent to have the right CPAs, right, tax strategists, and tax attorneys on your side. If you're just starting out and you don't have a lot of money, as soon as you pay any level of tax, having some level of tax expertise starts to benefit you. If you really start to get a little bit more wealth and start making more money. I think about back when I was just starting out, I used the shoebox method, right? I would just collect all my receipts and put them in a shoebox, and then about April 14th, I would go, I'd go just hire a basic, tax person and say, hey, here's my situation, and then they recommend an IRA. That's not ever gonna really save you. This is about making sure that you meet with a tax person at least once a quarter to talk about what it is that you can do to maximize your tax savings. And if you have more than $1 million in revenue, you definitely want to have a tax attorney, because there's something called the 3x3x3 strategy. There's three main buckets. The first one is the team that you have, and Donald has an amazing team, right? That is anything from a CFO or a controller or a bookkeeper, depending on the size. You can outsource that, or it could be someone in-house if you're big enough. And then you got timely data. The second thing is a tax strategist, someone that proactively seeks to help you maximize your tax deductions. And when it comes to tax deductions, you have to ask this question. A, could this be something that relates to my business or real estate portfolio? And that's what he's asking. And then B, how can you document that and let your tax team fight for you on it? The third thing is that attorney, right? So you've got the bookkeeper, you've got the tax strategist, you've got the attorney. The attorney can really help you to what's called reclassify your income. So if you own a lot of capital gain assets, like Donald Trump owns businesses and real estate, you can just let that grow year after year after year. And if it's not being sold, right, outright, and you already talked about how there's 1031s where you can transfer it, or charitable trust, if it's not being sold, you're not paying tax on that. You're not paying an income tax on it because it's a capital gain asset. And that's a major reclassification strategy, is if you can have the type of corporations or entities or investments that are capital gain oriented versus ordinary income, because capital gains can be 0%, 15%, or 20% depending on the asset and the amount of income, where ordinary income can be as high as 37.5%. I'm using the United States laws here, but you can kind of look at this in any kind of country. Now, this meeting with your tax team quarterly, and then every 3 years looking back, you can amend your returns if you've missed something. Look, getting the right team is so difficult, so I've got a great resource at wealthfactory.com/tax about the questions to ask and what kind of tax team you would need to have, and at what levels of income is where you would start to increase or build on that team. But having an amazing team gives Donald Trump, Robert Kiyosaki, a lot of these people, the ability to be fearless, right? Because they've got the right people to develop the strategies and defend the strategies and make sure that it's on their side. Now, the third piece really comes down to what I was mentioning before. There's a difference between active income. So if you're a W-2 employee and you have income coming in, it's the highest possible tax that you could pay. But there's other types of income like capital gains, which you're only paying upon selling. And this is where Donald Trump had it wrong in the debates, where he said, you know, Warren Buffett pays less in tax than his secretary. Well, the truth is Warren Buffett pays more, but he pays a lower rate because his secretary has a W-2 income, which is the highest tax rate. He has capital gains because he owns companies, and that's a lower rate, even though he's got so much more income that he pays more in overall taxes, but he pays a lower rate on that. And then the third piece is passive income. Donald Trump has a ton of real estate that comes in as passive income in those rents, and we talked about all the ways you can get write-offs and depreciation to offset that passive income, but it has no self-employment tax, where you pay what's called FICA, FUTA, Medicare. These are taxes on your income in addition to income tax, which is about 7.5%. Your employer might pay the other 7%, but you're paying that. When it's a passive income, you don't have that tax. Okay, so these are some amazing things that can lead to being able to avoid taxes altogether, minimize taxes. And so some of these examples could be businesses like a C corporation. Donald can have C corporations where he doesn't have to pay any tax on the earnings on the personal side. He can just keep retaining it from year to year. It could have stock ownership and then become a capital gain. He can use charitable trusts or other structures to be able to sell that tax-free. There's other things like something called a 1202, which is a way that you could sell a business for up to $10 million without any tax on it, or caps trusts. I'm just throwing these ideas of what is Donald doing to pay so little in tax. He's a real estate investor, he's a business owner, and there's so many advantages for that, right? So there's other things like a captive insurance agency, where someone like him can put up to $2.3 million per year and put it in pre-tax, insure all the risks, which he's got, I've heard, over 500 lawsuits against him. So this can be kind of those funds to help support that. And then there's no tax if it's liquidated, until it's liquidated, and it's just a capital gains. So look, if this feels confusing, realize this is about having the team that understands this clearly. And I want to help demystify that. Is this illegal? Is it unethical? Well, I don't know about the ethical side, but it's not illegal with everything that we're talking about here. This is about recognizing these things are possible. You may be paying way too much in taxes because you just don't know what's possible or not have the right team. And if you want to have the right team, you can go to wealthfactory.com/private if you're ready to build that financial team, because we've got multiple programs. We've got accountants and attorneys and all these kind of things, because you can either be upset or in awe when it comes to Trump and his taxes. But either way, there's something you can learn from what he's doing. So there are ways for you to legally pay less in tax, and now you have the knowledge to transform your thoughts into profits, because I want you to build the life that you love. If you're looking for more on this topic, check out my video on money-making secrets. Learn how you can make money from great relationships without transacting money. This is about being more resourceful. I'll see you there. We could all learn from each other. I call that relationship capital. It's the most underutilized resource that's out there in the world. So if you want better results in life, start asking better questions.